my greetings from Connecticut in the United States to you all for being on this call, and in particular to Martin for agreeing to talk with us today. Just by way of background, Martin, who of course is very well known, was the Chief Executive of Aberdeen Asset Management, which he co-founded in 1983. And under his leadership, it's worth remembering that they became one of the world's leading independent asset managers through a combination of organic growth and strategic acquisitions. In its first year, the business reported profits before tax of £87. In 2016, the figure was 352 million, so quite a good growth there. Aberdeen merged with Standard Life in 2017, as all of you will know, to form Standard Life Aberdeen. And following that merger, Martin was appointed Co-Chief Executive Officer, a role he stepped down from in March of last year. And he was Vice Chairman of the group from March of last year until May of this year. Martin is also Chairman of Revolut Limited, Tosca Fund, and the Oil and Gas Technology Centre in Aberdeen. He's also the Senior Independent Director at Glencore, and in 2011 joined the board of Sky plc, and in January 2016 was appointed Deputy Chairman until its acquisition by Comcast in 2018. Between 1995 and 2013, he was Chairman of First Group, having been a director of it since it was formed in 1989. He's a member of the International Advisory Board of British American Business, and previously he was Chairman of the UK Prudential Regulation Authority's Practitioner Panel, as well as a member of the International Advisory Panel of the Monetary Authority of Singapore. In 2015, the Harvard Business Review ranked Martin 22nd out of over 900 in its list of the world's top performing CEOs, and he was named Personality of the Year at the City AM Awards in 2017 and Asset Management CEO of the Year at the Global Investor Awards the following year. He holds honorary degrees from the University of Aberdeen, Robert Gordon University and Heriot Watt, and is an adjunct professor of finance at Imperial College Business School. He's honorary president of the Aberdeen social care charity, VSA. And to cement his Asian connections, it's worth remembering that he was born in Malaysia and earned an MA in accountancy and an LLB in law from the University of Aberdeen. And after qualifying as a chartered accountant with Deloitte, joined the investment department of local law firm Brander and Cruikshank, which went on to become Aberdeen Asset Management. And Martin will retire from Standard Life Aberdeen, I believe, on the 30th of September, the end of this month. So a very distinguished background and eminent qualification to chat about the most remarkable business that he has led. And Martin, thank you for being with us again and for the support actually of Aberdeen Standard for what we do at the Asia Scotland Institute. Without your help and that of others, we would not be able to function. And I wonder if we could kick off with asking you to just reflect on the extraordinary growth of Aberdeen Standard over the time that you have been heading it to its present size and the leadership challenges involved, and perhaps a few words about the 2017 merger.
Yeah, well, yeah. When I listen to you, it does sound remarkable in a lot of ways, but in a funny way, you never really sort of look back, and you keep looking forward because there's nothing you can do about what's happened in the past. So you may as well look forward. But what I would say is it's been great fun. And if it wasn't for the colleagues who were with me and the top team at Aberdeen who all stayed for 30 years, none of it would have been possible. So although I sort of was the sort of nominated leader of that of a group of talented individuals, it was really the team that took us to where we got to in 2017. 2017 was certainly remarkable in that we had a choice to make at that stage whether we pursued a merger stroke acquisition, a merger actually in the US, or a merger with Standard Life, and we took the view that the merger with Standard Life was probably a better a better course for our shareholders. Standard Life was, as you know, a remarkable business which has been around for close to 200 years, and had a strong balance sheet. We didn't realize just how strong a balance sheet it had when we did the merger, because subsequently our forefathers at Standard Life Aberdeen had been smart enough to invest in 2 joint ventures in India, which turned out to be close to £5 billion. So really, again, with the benefit of hindsight and a bit of luck, we moved into a very, very strong business, and jointly, I think the business will do very well in the future. I don't know there's much else I want to say, Roddy. Just really very happy to answer questions.
Perhaps I could ask you this one then, as you brought the 2 firms together, obviously people were looking for some economies of scale. Was that a difficult process?
Yeah, it always is. And throughout the history of Aberdeen, that was really why we did the strategic acquisitions, in that the mergers of asset management businesses, as long as you're growing organically, should benefit shareholders. Because you don't need 2 sets of everything, and revenues tend to be reasonably robust, and the same really took the same was really the case at SLA. That we're still going through the transformation process there, but hopefully it'll be over soon, and we'll come out of it with a stronger, leaner business than the 2 of us went in.
I remember a few years ago we had Hugh Young speaking to us in Edinburgh, and he mentioned how that business had started off in Singapore with him and one other above a coffee shop, I think. And he steered a very interesting course, avoiding some of these high-tech stocks. Has the success been because people were careful in what they invested in, would you say? Yeah,
probably over the long term we have been. It probably hasn't been the best move over the last couple of years, as we've seen the high-tech stocks do incredibly well. So we have bought some of them, and it's difficult. I mean, but Hugh has been very central in the growth of Aberdeen. I mean, he joined us in 1988. He moved out to Singapore in 1992. He had 100 million under management, and at the peak he had 100 billion under management. So Asia was really the rock on which we built the entire business. And from Asia, we built an emerging market business and an emerging market debt business. But Asia was really the key. And you mentioned I was born in Asia, and that was really a stroke of luck, because when Hugh Young said to me, Martin, I think we should relocate our Asian team from London to Singapore. And we went to Singapore, and I'll come back to why we went to Singapore, but that was a huge decision. And it took us 10 minutes to make the decision, because we both knew that Asia was going to be the center of growth in the world. And we still think over the next 30, 40, 50 years, it still will be where you probably want to invest money for the long term. So it was an incredibly easy decision to make. Then we were the first of the asset managers to relocate an entire team to Singapore, albeit a team of 2, because most asset managers at that stage would keep the head of Asian equities in London, but would have a couple of research people, mainly in Hong Kong, by the way. So we were the first to really go for Singapore, and we went there for a couple of reasons. One was no one else was there. we didn't want to go into Hong Kong, which was a crowded market. Hugh didn't like wearing a jacket, so that was another reason he wanted to go to Singapore. He couldn't understand why in Hong Kong you had to wear a jacket and tie, in the heat of business there. So he does, not only does he not wear a jacket or tie, but he doesn't wear shoes most of the time. So it's been interesting, but a tremendous move going to Singapore.
Wonderful. During the time that you've been leading the company, you've had to survive some quite extraordinary ructions in the market. 9/11, the financial crisis of 2008, and now the COVID pandemic. So not smooth waters at all. That's depended on a great leadership team, I'm sure, and flexibility on the part of the people within the firm.
Well, I think the interesting thing is, these downturns come out of a clear blue sky, and none of us predicted why. None of us predicted coronavirus, really. I had an inkling of it in January, and I remember saying to Nikolai at Revolut, I said, Nikolai, I am slightly worried about this virus. Can you make sure you get your fundraising? I really think we should get this fundraising done. And to be fair and to his credit, he got it done at a price that was probably not as high as he thought the business was worth, but certainly a price that certainly a price when you look back now looks okay. So, but the interesting thing about 07, 08 and this crisis is asset managers didn't have too bad a time, because stocks haven't gone down, and in fact quite the reverse, they've gone up in both of those. So the worst one for us was definitely the 2000 bear market during the split cap crisis, and that was the most crippling for us as a business. Obviously 87 was pretty crippling. I don't know how many of these downturns I've been through, but certainly March this year is one of the, if markets stay where they are, is certainly one of the quickest bear markets there's ever been. I mean, it lasted about a month, so yeah. It sort of hasn't been too bad, and bond values have gone up as interest rates have gone down. Obviously certain areas like retail property have struggled, but all in all, it hasn't been a bad recession, shall we say, for asset managers, as it is for other aspects of the economy, like hospitality, airlines, these sort of businesses.
And have you been invested in some of the sectors that have suffered? You've mentioned a couple just now.
Yeah, I mean, inevitably in the property world, you which tends to be a very long-term world, we probably had more property than we would want, because you don't want any, more retail than we want, because you really don't want any with this downturn in retail. But I suspect what it's done, the one thing COVID has done is speed up probably the decline in the high street, and we're seeing that at the moment. So the lockdown has had some pretty serious effects on retail spending and the hospitality sector, I would suspect.
I've got one more question for you before we open up to those who are participating on the call. Bev Henry runs your very successful business out of Philadelphia, I think. How has the US-China trade dispute affected the outlook, do you think, on Asia?
Yeah, I mean, clearly it's affected some of them, shall we say, the export-led stocks, but China's very resilient. So what we're seeing, and one of the things that surprised me has been how strong the iron ore price has been. So the Chinese are importing a lot of iron ore at the moment. So they're spending money on infrastructure. they're trying to boost domestic demand. So the economy is pretty resilient there, I would say. So once you step away from some of the state-owned enterprises, you can find some very, very good companies in the A-share market that have got pretty good governance, and that's where we've really concentrated our side. But Asia itself's very resilient. So yeah, they'll cope with the U.S. Trade war by boosting domestic consumption, which is what we're seeing in China.
Yeah, great. Thanks, Martin. I'm going to hand over to Doug Cook now to be the wicketkeeper and allow the bowls to come bowled at you. Doug.
Where are you in Philadelphia, by the way?
I'm not in Philadelphia. I'm in Southport, Connecticut, but I've been to Philadelphia and, of course, met Bev there. Yeah.
Yeah. Sorry, I knew you were in Connecticut. I meant Connecticut. I had a mental blank there. It's very nice. Very nice.
It is indeed. And so is Bonnie, Scotland, but I'm not there at the moment.
Yeah.
Thanks, Martin. Doug.
Martin, perhaps just before I go to audience questions, if I could just pick up on your last point and your earlier point. You seem to be quite positive about Asia in the long term, and you've just talked about China. But obviously we've got a membership that's very interested in Asia generally. And I just wondered, when you look at outside of China, across Asia, if there are any particular areas where you see value, and are there concerns about corporate governance in those areas as well? And specifically perhaps about the ASEAN and what sort of your view on that area?
Yeah, probably. I mean, our biggest weighting is India, which has been phenomenal, but it's very difficult to say there's value in India. But there's some very, very good companies there, including the two joint ventures we have in India, HDFC Life and HDFC Asset Management, and obviously HDFC is a fantastic company, with a pretty high rating at the moment. What else? So yeah, we like India. The Unilever Hindustan is a great business, but as I say, value wise, it's stretched. So probably towards ASEAN would be where I would be saying the value is at the moment, and I often say ASEAN's a bit like the EU without the parliament. So it's got terrific opportunities, I think, and so I like ASEAN probably the best at the moment of the stocks. I do like the China A-share market, or rather we like it, and I think that's also gives opportunities there as well.
Martin, thank you. I've got a question from Peter de Vink. Peter, if you'd like to ask your question first, please.
Oh, not Peter. How are you, Peter?
Am I allowed to come on to the video or not?
Of course you can, Peter, yeah.
I'd like to see you. I'd like to see you, Peter.
Anyway, you have stopped me on the video, but hopefully you can hear me. Martin, I've always enormously admired your wonderful entrepreneurial flair and the way that you have managed to do something that very few people have achieved. I love the way that you have given all the credit to other people, but you were the engine driver, and I always felt that you were class act. However, when you bought Standard Life or merged with Standard Life, that was a brilliant acquisition. But then you did something that really I couldn't understand, because the life business is really almost a better long-term multiple company than investment management. And you sold it off to a great friend of mine whose father ran the 1 mile in 4 minutes, Clive Bannister. And I just thought it was a great acquisition for him, but not a great sale for you. Would you like to comment?
Yeah, no, I think the when we were sitting down with a potential merger in the US, a potential merger in Scotland, with the chairman, Sir Jerry Grimstone, his vision had always been to try and create a Scottish-based global asset management business. And Keith Skeoch and I shared that vision. So the whole merger was prefaced around that, and really it came down to divesting the life company, either working with Lloyds Bank. As you know, there was a potential to do a deal with them, or potential to merge into Phoenix and taking a significant equity stake with Clive. And like you, I admire Clive. I think he was a tremendous CEO of Phoenix. And now, of course, Phoenix have gone on to merge with the Credit Suisse subsidiary. So we saw a lot of opportunity in the consolidation of the life sector. So that was really why we did it. We wanted to merge the life companies and also go out and merge other life companies into it, which is what Phoenix have done, and therefore get more assets under management, which was what we were really interested in, and building a global asset manager based here based in Scotland. So it was a good deal for us all. And Clive probably he did a good deal for his shareholders, and we felt we did a good deal for our shareholders. Returned a lot of cash. So we've returned huge amounts of cash to shareholders over the last 3 years. I would say close to £3-4 billion we've returned to make the return to shareholders, to boost the return to shareholders. But I think the benefits of what we've done are yet to come through, and I think the new CEO, Stephen Bird, who is world class, by the way, I think this guy is incredibly fortunate that because of COVID, we got a CEO that had run Citi in the US, had run Citi in Asia. So very, very good knowledge of Asia while he was running Citi in Asia, but happened to live in Edinburgh. And because of COVID, came home to Edinburgh for a prolonged period and enjoyed it so much. He thought, gosh, this is quite good. This is quite reasonable. And he turned down some big jobs of heads of US banks to stay in Scotland and run Standard Life Aberdeen. So I'm very confident that the board have really appointed someone who is exceptional by any standards, and it's great that someone sort of returned back to Edinburgh, and we're attracting leaders of that quality back to running our businesses in Scotland.
Well, that's fantastic. I had one added question. Am I allowed, Doug?
Yeah, I would love to hear it, Peter. It's like Alan Jope of Unilever. Yeah, he's exceptional, by the way. He's absolutely exceptional.
Yeah, he is. And he loves Edinburgh just as much as your friend. Anyway, just the one thing.
He's Glaswegian. That's the only problem with Alan, I think. You can't have it all. You can't have it all.
Can't have it all. But he lives in the new town, which is the important thing.
Yeah.
Now, very interestingly, very few investment management houses have really seen the death of carbon. And the one person that has seen it is James Anderson, Scottish Mortgage Trust, the largest company in the FTSE 100. I mean, just quite, bigger than anything else in Scotland altogether. Anyway,
14 billion, I think I read, isn't it? 14
I
billion.
know.
I'll tell you, he is an exceptional asset manager.
But he saw the death of carbon.
Yeah.
I don't think you at Standard Life, Aberdeen Standard, did not see it like that. Can you just comment on that?
Yeah, I mean, as I say, he's exceptional. And Scottish Mortgage, I wish I'd invested in Scottish Mortgage. I mean, it's now what, 14 billion, one of the biggest companies on the FTSE. So incredible company. But give James his due. I mean, he backed not only the Amazons and the what I would term the Apples, the normal sort of easier ones to back, but he really backed Tesla. And even when he was under pressure, it shows what a great fund manager he is, that he withstood the pressure. And it reminds you a bit of how Hugh Young is as well. He's exactly the same. The really great fund managers are not only sort of humble human beings, but they have this sort of maybe streak of obstinacy that they can stand a bit of criticism, even from within. I suspect even at the time, probably James was probably getting a bit of heat internally, saying, "Why are we holding Tesla, etc." And give him his due. He held it through the bad times, and now he's probably top slicing it during the. In fact, I know he was top slicing it during the good times. So he's exceptional, and yeah, Baillie Gifford's a firm I admire immensely and always have, and we'd probably all be better off if we were partners in Baillie Gifford than anything else, So no, it's great to see them doing. It's great to see they've done so well based in Edinburgh.
Martin, thank you. I'm going to ask Stuart Langdon from Leapfrog Investments if you would ask your question, please.
Yep. Hi, Martin. Thank you very much, Doug. I was just very curious about this decision you've made. I was going to say recently, but it must be more than a year ago now, to join the board of Revolut. I mean, you've talked a lot about Standard Life and Aberdeen and Scottish Mortgage, all very traditional fund managers in a way, and now you've joined the board of, I think in fact you're chairing the board of this business that I think is the most valuable startup in Britain, or certainly within financial services, and very much the model of the new age, cutting edge kind of digital firm. So would you just be able to talk a bit about what drew you to that, and in particular why you sort of zeroed in on Revolut in particular?
Yeah, no, it's a good question. That actually, I mean, I obviously admired the company, and I met Nikolai, and the shareholders were looking for someone who had started a company, who had a few gray hairs, who had a bit of regulatory experience in the financial service sector to chair the company, and they asked if I would do it, and I said, yeah, obviously I said yes, because I was attracted to the fintech sector, and I think it's important we all sort of try and take ourselves out of our comfort zones, and my comfort zone was obviously the Standard Life Aberdeen, Aberdeen Standard, these sort of traditional companies, as you said. So it was really just to bring myself, just to, I don't know, reinvent myself is the best expression I can come up with, and really try and help a business that was sort of a bit like Aberdeen was maybe 20 years, not right back at the beginning, but certainly and was trying to grow in the same way we did it in Aberdeen globally. So places that I was familiar with: Canada, America, Singapore, Australia, Hong Kong, Japan. So all these countries, they're looking to expand. I have experience of regulators there, and was on the board of the MAS International Advisory Panel in Singapore. So So yeah, it was just to. I just thought it was fascinating to try and do it, and so was very, very keen to do it. And I must admit, I've enjoyed it immensely. It's great to be in. It was great to be back in a really fast-moving business where they make decisions quickly. They worry about the consequences of the decisions after they've made the decisions. A bit like you can do when you're small and nimble. So it was great, and it's going to be a winner over the long term, in my opinion.
Fantastic. And if you were to add because to the end of that sentence and say you think it's going to be a winner
because of the well, it's not tied down by legacy systems and legacy infrastructure like the big banks are. So it's got a very efficient operating model, and obviously the key is to become profitable as soon as possible by the end of this year and next year. This sort of thing too. And clearly, of course, we raised the cash at just at the right time. But because the app is going to make financial services simpler, and it's going to go into everything. It's going to go into asset management. So for us in the traditional businesses, it'll try and come in and undercut us, and they already do free share dealing. You can buy gold and silver online. You can buy shares free. It's an incredible app. You can buy currency free. The currency transfers. It really is an amazing. It really is an amazing business.
Yes.
Hopefully we'll keep growing.
Thank you. Very helpful.
Martin, thank you. I'm going to turn to Jenna Donaldson from Qatar Airways. Jenna, if you'd like to ask your question, please.
Yes, I'd be delighted to. I hope you can hear me okay. Hello, Martin. Thank you so much this afternoon, given great insight into your past and the future. Before I even go into the travel side, I'm the biggest fan of Revolut. My partner always asks if I'm working for Revolut because I sell it so well. Because I travel a lot and I haven't found a country yet I've had any difficulties with it. So I do think it's a great.
I hope you've got the metal card then. I mean, you really need to upgrade to the metal card.
Great sales pitch. I haven't got to the metal card yet. But I did take advantage of the perks over lockdown. Great.
Oh, great, good.
Yeah, I did like that advancement. But on the travel side, of course, I'm going to ask you, do you think the limitations on travel right now is impacting business, and like it's definitely in reference to relationships and sales growth opportunities?
Yeah, well, I mean, look, we're not all lucky enough to work for Qatar Airways. In the travel business, so at least you're with an airline that is which has the backing of a very wealthy state. So I think it's a good place to be, but I worry about the cash burn in some of these airlines, and the way the governments are placing travel restrictions is really denting confidence. So they've got to come up with a way of encouraging people to travel and to be tested at airports or whatever it might be. So the sooner we get to faster testing, the better, so that people can be tested as they arrive back in the country and perhaps a week after they arrive back. But we've got to get the sort of we really need to get the economy moving again, including travel, including hospitality. I mean, I'm sitting in our office in London. There's 4 people in, 5 people, 6 people in an office that would hold 1,000 people, and you can imagine what it's doing to the local economy roundabout. I mean, it's just killing the sandwich shops, the food shops. So it's the sooner we get back to people feeling confident to come into the office. And that's what it's all about, is confidence now to come back in, confidence to travel on the tubes and trains is really going to be the biggest hurdle of getting people back into work.
Yeah, I completely agree on the confidence, especially on the business traveller side. So thank you very much for giving.
Yeah, I still think the Atlantic corridor, which is a really profitable area for airlines, needs to get back up and running as well. And I just don't see that happening anytime soon. Nor the Far East corridor. I mean, everything's closed down, isn't it? So the only travel that's happening is short haul in Europe, really.
We're exceptionally busy with repatriation still, believe it or not. And actually, CEOs still being moved around into new positions across the globe.
Yeah.
So we are being kept busy, but it's very, step by step.
Yeah.
It's been a lot of work.
Martin, Jenna, thank you. We've got a question from Alison Cuthbert. Alison, if you ask your question, please.
Good afternoon, Martin. Thank you very much for speaking to us today. I was interested to hear your thoughts on impact investing, just given that I suppose ESG and in particular impact investing has gained a lot of interest in the market in recent months and years, and how you think Standard Life will, or Aberdeen, should I say Standard Life, will respond to that.
Yeah, I think the world started with as you know, largely concentrating on governance, basically. So that was what the governance teams did under ESG, and really the G was what people mostly concentrated on. And then sustainability came in, which was a sort of subset, really, of ESG, and people started to, investors like ourselves, concentrated on things like carbon neutral, carbon zero, all of these sort of things. But I think the world is going to move towards impact. I think impact is going to be the next big area of investment, because there is a generation who are more interested, who have moved on even from sustainability, i.e. our companies operating in a sustainable manner, to they want companies to do good as well, to be benefiting the world. And so I think it's a massive area going forward, and it is an area we're concentrating on. We almost launched an impact fund, a global impact fund. It got hit a bit by Brexit and the Brexit vote and so on, but I think over time we're going to see a generation demanding that fund managers not only consider ESG, not only consider sustainability, but also consider impact as well. So I'd put it really into those three buckets, but impact is becoming more and more important as well.
Thank you. That's really interesting. If I'm allowed, just a quick follow-up question. So I take it there's no sort of concerns that you need to sacrifice returns in order to achieve impact?
I don't think so. I mean, you may get a slightly lesser return, but I think people are prepared to accept a slightly lesser return in order to see that fund managers like ourselves are investing on their behalf. There's certainly in sustainability much more advocating that we take a tougher stance on sustainability. So even in the US, which really lagged behind the rest of the world in sustainability, are even now there, our clients are demanding that we take it into account before we invest in a company. Impact hasn't quite reached that yet, but but I do see impact becoming more and more important over the years ahead. But it's not there yet. It's not at where sustainability is at the moment.
Fantastic, thank you. Well, I'm a big believer in impact investing, so that's
Yeah, no, well,
here.
yeah. You must be young then.
Just a millennial, but only very just.
Well, that's the interesting thing. It is that generation that are going to demand impact, and certainly Revolut, when they move into the investment business, will take that into consideration, because a lot of their clients, and there are 12 million clients now at Revolut, are interested in impact.
Thank you.
Martin, thank you. We might ask your advice about for young investors in the future, but I've got a question from Ross. Ross, if you'd like to ask your question, please.
Sure. Thanks for joining us today, Martin. It leads quite nicely on from the previous question that was asked and your thoughts on Revolut. It was just to get your thoughts on how you see the future of traditional asset management with the maturity of kind of larger DB schemes as clients, and then increasing accessibility for retail clients through technological change and through challenger apps like Revolut, like you mentioned.
Yeah, I know that's a interesting question, because traditional asset management has got sort of three big headwinds at the moment. One is this active to passive, which we're seeing more and more of the large asset owners in the world are using passive, because active fund managers have tended to underperform for varying reasons. One of them being what James Anderson has really has seen is the rise of the big five technology companies as a percentage of the S&P, well over 20% now. So that has caused our active guys to have a tough time. Then because of that, we've seen fee compression. And then another interesting headwind we've seen in the DB pension schemes that you mentioned is a move from public markets to private markets. So by private markets, I mean non-public bonds, non-public equities, so private equity, private credit, property, aircraft leases, all sorts of asset classes would fit into that category. And all of these have hit traditional asset managers. So certainly you've got to really swivel your business, and well, two things. You've got to make your business more efficient, which is why one of the reasons we did the merger between Standard Life and Aberdeen. And secondly, you've got to really think about going directly to the customer rather than through intermediaries. And again, that's a route that we're exploring, and certainly swiveling the business that way is certainly one of the answers as individuals, because individuals can no longer rely on defined benefit schemes, but have to go to defined contribution. Everyone is going to have to take more responsibility for their own finances in future. There's not going to be the company safety net any longer. So yeah, like all asset managers, we have to swivel our business away from the DB schemes to the individual who's contributing to the contributory schemes. And I would certainly like to see more compulsory saving in the UK. I know we've made a start on it with everyone having a pension scheme, but we're still quite far behind the Australias, the Singapores, Chiles of this world, who have been doing it for longer than us and have built up very substantial superannuation in the super funds in Australia, the Canadian funds, the Chilean funds, who are big clients of ours, Singapore. And because they've been doing it and they've got this surplus cash flow, or they've got no necessity for cash flow, immediate cash flow, they're the big investors in private markets. So hence the Canadians own airports here. They're the biggest owner of student accommodation in the UK. So they've been really leading this drive into private credit. And some of the big Canadians would have 50% in non-public markets now. So they've become big owners of infrastructure here in the UK.
So do you see the kind of the more traditional asset managers becoming specialists in these kind of alternative asset classes and leaving the more mainstream products like your equities to potential challengers like Revolut when the service develops more in the future?
Yeah, I probably see what I would term the more traditional asset classes, the competition there coming from the iShares of this world, the low cost ETFs or exchange traded funds. But certainly the world of asset management tends to split into the global fund managers and then the boutiques, and certainly the boutiques will usually, they'll do pretty well if they concentrate on one asset class and are good at that asset class. So you'll see someone with 10 billion in private credit, and they'll be doing really, really well. As long as they're good at their one, at the one asset class they manage, they'll tend to be pretty good. But large companies like ourselves, I mean, we're of course trying to move our model to into private markets as well. So it's pretty, yeah, it's pretty good. But it's a bit like if you asked someone in the US, I'd like to invest some money in emerging markets, they would name Aberdeen. If you asked them, I'd like to invest some money in property, they might say, well, Blackstone. So they don't automatically think of us in property, although we can do property. So there's a bit of that as well. There's even the big asset managers tend to get pigeonholed into certain asset classes.
Martin, Ross, thank you. Thank you very much indeed. We've got a question from Isaac Tabner. Isaac, if you'd like to ask your question, please.
Yes, can you hear me okay?
We can, thank you.
That's great. So Martin, it's kind of a follow-up question to the response that you were giving to I think it was Jenna from Qatar Airways when you were talking about getting its business back into the capital. It just kind of seemed as if you were advocating a return to business as usual, but I was just wondering if you have a space for a contrary view that this is an opportunity to reset productivity and level out prosperity away from capital cities, and maybe we've actually hit a major structural break in the era of central office buildings is maybe gone, and people are going to be working from home now, and maybe we have to live with fewer Pret and Mangas in central London, but
Yeah,
maybe a few more delis and other interesting things out in more rural areas, which have for a long time been deprived, and as you've seen, a concentration of wealth into the big capital cities.
No, it's not really a contrarian point of view from mine. I think you're right. I'm not convinced people will ever return to everyone coming to the office every day. I think if that does happen, that's going to be a long time off. Nor do I think we're going to have a situation where everyone works from home every day. So I think it's going to settle down somewhere in between, and I think that's great if it does. By the way, I think teams need to get together maybe once a week. These are just personal opinions, so please don't take them as our corporate view. I still think teams need to get together occasionally. I still think there is a necessity for some face-to-face meetings. I think you depend on existing relationships at the moment, and I think I'm not convinced any of us are creating new relationships or refreshing our relationships, which are sometimes done face to face. I mean, don't get me wrong. I've loved working at home, by the way. I was in I haven't spent as long in my home in Aberdeen for 30 years. So it was the greatest. It was really great. I loved it. But I also quite like doing a bit of face-to-face as well. But I don't think we'll see 100% return to offices again, especially in London when I'm sitting in, as I said, I'm sitting in our office in London here. And they're going to have to halve the occupancy of these offices just to comply with the 2 meter sort of rules. So it's just not gonna go back to 100% of that. I'm pretty certain, not in the short term anyway.
Okay, thank you very much for
and,
that.
And I totally agree. I loved visiting the deli that I used to go to in Aberdeen all the time. And I've become a huge advocate of local supply as well. I think we've all got to look at where the supply chain in food is as well.
Martin, Isaac, thank you very much indeed. I'm going to hand back to Roddy now.
Doug, thank you very much indeed. Martin, thanks for answering all these questions. I have got one for you. Incidentally, Stephen, your new CEO, is due to talk to us in a few weeks' time. So we've got him coming, and we've also, as we were talking about airlines, got Gordon Dewar from the airport, and as well Clive Bannister, because although he's retired now, I think he would have some interesting things to say. So we look forward to hearing from them. But with regards to your kind answers, I wonder, given that we are all about educating and inspiring tomorrow's leaders in Scotland, and I often say to people, when I was their age, people said to me, "Go west, young man," which I did eventually, and now it's "Go east, young person." What would your advice be to younger professionals about how to engage with Asia, and perhaps what areas to invest in?
I still think it's a great area to go. Asia, I would definitely, I mean, it's absolutely the place. I think China probably rather than Hong Kong now. Always Hong Kong was the place to go, as you know. I think Japan's changing. I think if you spoke Japanese, that would be a great area to go, but difficult to integrate there probably. It's still ASEAN for me. It's still Malaysia, I would say. My father went there in 1950. There you go. That's 70 years ago. Jesus Christ, isn't that incredible? And it's still the place for me because I still think it's got the most potential because of the land. I think Singapore is the best place to live you can find in Asia, but it's a city state. And that's its advantage and also its disadvantage. So yeah, it's great. But yeah, when you get Stephen Bird on, tell him I said he was a rock star. Would you? Just that'll embarrass him.
I certainly will. And I told Clive in an email that his ears should have been burning red because you and Peter de Vink were saying nice things about him. So yeah,
he's a great guy, Clive, isn't he?
Yeah. Great chap.
If only he could run as fast as his father, he would have been even better.
His father was a remarkable man. Quite right. Yeah. Well, Martin, thank you. We can't thank you enough for giving up the time to talk with us, for all the questions you've answered. And as I said at the beginning, thanks to Aberdeen Standard for the support they give us as the still young Asia Scotland Institute, which slightly surprises me it didn't exist before, given the close contacts between Scotland and Asia. I sometimes sort of ponder on the fact that the population of Scotland and Singapore is the same, but after that, much is not. So I wondered, my final question to you is, should we be encouraging, if it happens, those able to leave Hong Kong and wishing to do so?
Yeah, definitely. Definitely. The benefit to the west coast of Canada, didn't you, by a lot of people going there from Hong Kong. Yeah, I mean, look, I don't want to get involved in a political discussion about whether it's the right thing to do or not, but it would certainly boost the economy, that's for sure.
There we go. Good.
Great.
Martin, thank you. Oh, Peter,
you.
thank you. There you are, clapping. Thanks again.
Well done.
Well done, well done. And Doug, thank you too. Do you want to just close things off?
I'd love to. Martin, if I could echo Roddy's thanks. Thank you very much from me as well. And thank you from everybody participating. And just to let you know, we have another event, Roddy mentioned it earlier, on the 14th with Gordon Dewar, the Chief Executive of Edinburgh Airport, talking about the aviation sector. And we have the International Rescue Committee and David Miliband talking on the 17th of this month as well. So we look forward to seeing you those. Thank you.
Thanks, everybody. Thanks for your participation.
Thank you.
Thanks, Martin, very much indeed.